G'day, this is Sydney Options Trader. We're looking at the Think or Swim brokerage platform, and we're just going to look at an alternative to at market orders by using a contingent order and marking it off the mid price. Now, this contingent order is something that's helpful to get in and out of positions, especially if you don't watch the market live, like a lot of people who trade from around the world. The time zones are different, but it just means that you're not exposed to the massive changes in charges that the market maker will fill you in terms of the worst price within that market order. Now, of course, we can also get around that by trading only very liquid options, so even an at market order will enable you to only have a small slippage cost. But this technique that I'm going to show you also will enable you to shave but get filled at the same time. Now, like anything, there's no guarantee of getting filled unless you place an at market order. It's still a limit order, what I'm about to show you, so there are possibilities of not getting filled, but we can certainly put the odds in our favour and get a better price than at market. So if we look at the Analyze tab, we go into Simulated Trades, and we put on a trade here that we looked at. We're going to buy the December 136 call. Okay, so we're just going to press on the buy, which is the ask, the December 136 call, and it's going to cost us $3.70 or $370 net out of our account. Now, basically, we're going to get straight into that after a quick scan of the risk graph. Yes, that's what I want. We are going to create a duplicate order. Now, at this point, rather than do an at limit, we are going to go into this cogwheel area, I call it, which is the inner workings of an advanced order. Here are the order rules, and what we're going to do is we're going to need to put in the symbol GLD, we're going to do the mark symbol, we're going to do at or above, and because this is a bullish trade we're simulating here, obviously the market's not going to move by a massive amount, but we want to get filled, so I'll just say at or above 133, because it will certainly be above 133 if you're placing this out of market hours before the market opens, unless it has a massive drop. Then you're not going to want a bullish trade anyway, but unless it has a massive drop, you will get filled. So that's the threshold. It's going to be at or above. Now, the limit we're going to do here is not the manual. We're going to do it at the mark, and that will give you the mid price or the fair price of the option. The mid, and we're going to offset it. Now, because we're buying or we're going long this option, you would need to give the market maker something. Now, this limit offset is the decision of how much you want to give him. Now, the question is, how much do we want to give the market maker? And that's a good question. It's going to depend on the liquidity of the actual underlying that you're trading. So if we go back to add simulated trades, you can see here there is a 10-cent at the money difference between the bid and the ask. There's 10 cents everywhere there. Okay, so basically the mid price for our option will be $3.65. Now, if we give the market maker 1 cent, then we will pay $3.66 if the price of the underlying of gold doesn't change between now and then. But we don't know how much it's going to change between now and the open. So what I often do is, rather than do mid plus 5, because mid plus 5 is basically the same as saying 365, which is the mid, plus 5, which is 370. That's the same deal as an at market order. You're going to get filled at the worst price. So if we went roughly about the half, now if we're aggressive we would do mid plus 2, because the difference is 5 cents. So, but if we want to be a little bit more liberal, and you would be assured of getting filled if you did mid plus 3. So that's what we're going to do for this particular one. We go back into order entry, which is down the bottom here. And you go back into this, the inner workings, the cogwheels of the order rules. We're going to do GLD method mark at or below 133, sorry, at or above 133. Not doing manual, we're doing mark, which is the fair price, the mid price, and we're not going to do minus, because we've got to give the market maker something. If we're aggressive, we'd do 2 cents, but really to assure ourselves we're getting filled, we'd do 3. We're not doing good till cancel, we're just putting it in for a day order, we're just buying 1 GLD 136 call. Press OK, press confirm and send, and of course here's how it shows up, at mark plus 3, limit. So we are getting a better fill than the at market, and our likelihood of getting filled is very high. We press send. You look over here at the working orders just to confirm that it will pop up. And there it is. Buy GLD December 136 call, mark plus 3 cents, limit day order 365, waiting for the condition, which is basically that's going to be above 133. Of course it's at the moment it's 136, so by open you would assume that it would still be above that. Now to check those inner workings, you can press on that cogwheel to explain the order. It's all there. Now you can actually do a, if you found that there was something wrong, you could do a cancel and replace. You could change the limit. But if you wanted to change the threshold or anything in particular, you would have to go in and change the order rules. But we're happy with that, so we will confirm and send. Send again. And it cancelled the order, it's replaced it with a new one, and we're ready to go. So that's a limit mark order, which is basically going for the mid price and giving the market maker a bit less than he would get with an at market order. Hopefully this is helpful. If you want to give us any questions, you can send it to us on sydneyoptionstrader.com. No, it's not. sydneyoptionstrader@gmail.com. Good evening to you.